Welcome to Talk Tickers. Today, we're diving into Park Aerospace's latest earnings. Now, on the surface, the quarter looked pretty solid, but the stock immediately tanked over 5%. So we're going to figure out exactly why and what that really means for the stock going forward.
So here's the puzzle, right? Operationally, Park Aerospace delivered. Their earnings were right in line with expectations, and they hit the very top of their profitability goals. But the market, it just hated it. A major sell-off on really heavy volume. This is the kind of disconnect we love to dig into. All right, first things first, let's look at the actual numbers. What did the company really report?
I mean, just look at this. The profitability numbers look fantastic. Earnings per share? Bam, right on target. Gross margins expanded in a big way, and their adjusted EBITDA hit the high end of what they told everyone to expect. Yeah, okay, revenue came in just a tiny bit shy, but based on everything else, you'd think this was a reason to celebrate.
But that solid profitability, it just didn't matter. The stock closed down over 5.5% the very next day. In a move like that, on 3 times the average trading volume, well, that tells you something important. The big money is looking past the headlines and has its eyes on something else entirely. So, what spooked everybody? Well, the answer, as it so often is with these manufacturing companies, is kind of hidden in the details, specifically in their sales mix, and it points to a real near-term headache. And here is the whole issue in one chart. The company sold a whole lot of the raw material called Raycarb C2B. We're talking about $1.65 million worth. Think of this like a baker selling raw flour. But they sold way less of the finished, high-value product that's made from that material. That's the finished cake. So when you sell more of the cheap flour and less of the expensive cake, your overall profitability takes a direct hit. And you don't have to guess why. The CEO, Brian Shore, laid it out plain and simple. Defense customers are so worried about their future supply for huge programs like the Patriot Missile System that they are just stockpiling the raw fabric like crazy. So yeah, it creates a margin headache today, but it's also a massive flashing sign of incredible future demand for the high-value stuff down the line. And you know, that brings us to the long-term story. Because while the market was completely fixated on this short-term mix issue, management was busy painting a very, very clear picture of 2 massive growth engines that they are building this entire company around. They're calling them their 2 juggernauts. First up, you've got the big recovery in commercial aerospace. Specifically, their position as the sole supplier for key GE jet engines on planes like the Airbus A320neo. The second, and honestly, the more powerful engine here, is this unprecedented surge in demand from the defense sector, especially for missile programs. And they are absolutely putting their money where their mouth is. The company announced a $40 to $45 million facility expansion. Now, to put that into perspective, that is more than half of their current annual revenue. It is a massive bet on the future. And get this, they're doing it all without taking on a single dollar of debt. So, this is the crucial point. You have the COO, who the CEO himself describes as the resident skeptic in the room, calling these once-in-a-lifetime opportunities. That's the level of conviction they have inside the company, and it's just such a stark contrast to the market's knee-jerk negative reaction. Okay, so how should we process all this? What's our take on this mismatch between the short-term freakout and management's very ambitious long-term plans? Here's what we'll be watching for. First off, the Q3 guidance they gave suggests things are going to be pretty stable. But for the stock to really start working, the story needs to change. We need to see that stockpiled flour getting turned into high-margin cake. That is priority number 1. After that, the market's going to want to see real, tangible progress on that new facility. And of course, any big new defense contract wins would be huge. So for our official rating, we're calling this a market perform. We think the market is right to be a little cautious about the near-term margin pressure. That's a valid concern. But we also think that caution is making everyone miss the massive multi-year growth opportunity on the defense side of things. Our 6 to 12-month outlook puts the stock in that $21 to $23 range as that story starts to become a lot clearer. So what's a potential trade idea here? Well, given this mix of short-term uncertainty and that huge long-term potential, you could look at something like long-dated call options. In simple terms, it's a way to bet on the stock going up over the next year or so, while strictly limiting how much you can lose if you're wrong. It's really a strategy to try and capture that juggernaut upside while protecting yourself from any more of the short-term noise.
And as always, please remember this is not financial advice. All of this analysis is for informational purposes only.